Hello and welcome everybody. Today we will be covering risk management, a crucial yet often overlooked area of trading. This webinar is brought to you by Scandinavian Capital Markets. Let's take a look at what we're going to be covering today. A quick overview. We're going to be talking about human psychology in trading and how there are some peculiar quirks in our behavior. We're going to look at some technical terms like drawdowns, the classic 2% rule. We're going to look at what is a risk to reward ratio. With stop loss strategies, we'll be covering a variety of different stop loss strategies. We're going to look at some more complex areas such as the Kelly Criterion, and finally the Martingale and anti-Martingale strategies. So by way of kind of a broad overview, I wanted to bring up that traders often place all their focus on areas such as finding entries and exits while neglecting to have a clearly defined strategy for managing their risk. But having a well-defined strategy for managing risk is probably equally important to your actual strategy involving your entries and your exits and this kind of thing. So a well-planned risk management strategy can ultimately make the difference between success and failure in the markets. It's that important, and that margin is often razor thin. So as usual, a couple of quotes to start out our presentation. This one from Ed Seykota, who's profiled in the Market Wizards book. He says the elements of good trading are 1. Cutting losses, 2. Cutting losses, and 3. Cutting losses. If you can follow these 3 rules, you may have a chance. So no surprises, cutting losses is a very important part of risk management and trading here. And the second quote I wanted to bring up from Warren Buffett says, "We simply attempt to be fearful when others are greedy and to be greedy when others are fearful." So he wants to do basically what the opposite of other people are doing, and what the opposite of behavior that people are naturally inclined to do, and that's something that we're going to talk about. Let's unpack that concept a little bit more. Looking at the Kahneman and Tversky study, this is a study by 2 behavioral economists that look at how people manage risk and uncertainty. So in this study, subjects were given a choice between a certain $3,000 gain versus an 80% chance of a $4,000 gain and a 20% chance of getting nothing. So the clear majority chose the $3,000 gain. The question was then flipped, and subjects were given a choice between a certain $3,000 loss and an 80% chance of losing $4,000 with a 20% chance of losing nothing. Here the majority of people chose to take the 80% risk of losing $4,000 along with a 20% chance of losing nothing. So in both instances, the subjects made irrational choices from a mathematical perspective when calculating an expected gain or loss. And the study shows how people are curiously risk averse when there is a prospect of gains, and then they become risk takers in a scenario involving loss. So if you've spent any time in the markets and around other traders, I think this concept will surely resonate with you. I've seen it time and time again in my own personal experience. That is the idea that people tend to take on more risk when they're fearful, when they're in a losing situation, which is actually the opposite of what they should be doing. It leads to ruin in many cases. So this irrational human quality of embracing more risk in a losing scenario and less risk in a winning scenario is at the root of the failure of most traders to succeed in the market. Very simple concept, but quite profound. Next up, let's talk about drawdowns. Drawdowns describe a period of loss during the execution of a trading strategy. So every trading strategy, every trader has losses. Such losses are inevitable. So everyone has to face drawdowns to some extent. What's important is that a properly defined risk management strategy will allow you to survive the drawdown periods and execute your trading strategy properly. Next up, let's talk about the classic concept of the 2% rule. The 2% rule states that you should never risk more than 2% of your account equity on a single trade. Having such a rule in place helps you become more emotionally indifferent to the outcome of the trade. So if you're only risking 2%, it's much easier to be objective, to just kind of calmly, intellectually note the outcome of the trade and move on to the next one. Whereas if you were overinvested and took a large amount of risk, you might well become emotional, lose your head, and make bad decisions. So when using the 2% rule, you should be able to survive even extended drawdown periods. Doing this, you'll not only be able to properly execute your strategy, you'll be able to evaluate it also. Another important subject is to understand how difficult it is to recover losses in percentage terms. So in the event of suffering heavy losses to the capital in your trading account, when you make some bad trades, you lose a lot of money, the percentage of return needed to recover your lost equity is remarkably high, because of course now you've got less money to work with. So let's take a look at some of the statistics here. With a 25% equity loss, you would need a 33% return to get back to break even. With a 50% equity loss, you need a 100% return to recover former equity value. A 75% equity loss recovers a staggering 400% return to recover your former equity value. So again, we can see the more you lose, the harder it is to come back. The harder it is in percentage terms to recover the initial losses. So understanding these statistics reinforces the importance of always having, this solid risk management strategy in place. Next up, let's talk about another common term you hear, risk-to-reward ratio. A risk-to-reward ratio describes the relationship between the amount of risk you're willing to take and the gain that you're hoping to achieve. So for example, with a risk-to-reward ratio of 1 to 4, you'd be willing to risk $100 to potentially make $400, or $1,000 to potentially make $1,000 to potentially make $4,000. The conventional wisdom is that it's better to have a profit target greater than your risk allowance to help you optimize your chances of success, but where you really see this as being important is more in trending markets. So particularly in a trending market, you're going to want to have a profit target larger than your stop loss, your risk allowance. In range-bound markets, you might actually experiment with other arrangements of the risk-to-reward ratio, which may indeed be more effective, and that is in choppy sideways markets. Now let's talk about stop-loss strategies. So as the name suggests, stop-loss orders are designed to limit a trader's loss on a position. There's various different types of stop-loss orders, a stop limit, stop market, but basically these are just orders that are designed to limit your loss and are executed when price reaches a set level. So let's look at some different approaches to using stop losses as part of a risk management strategy. To begin with, you could use an equity stop. So using this method, a trader will risk a fixed percentage of their equity on a trade and uses this to determine the placement of the stop loss order. So they're willing to risk a certain dollar amount, and they use that to calculate where to place their stop loss. Then you might use a chart-based stop. Here a trader might use technical analysis, looking at trend lines, support and resistance levels, to decide the position of where to place their stop loss order. Next up, we got a volatility-based stop. This technique uses market volatility to decide where to place the stop loss. So you might use a technical indicator such as average true range to determine the volatility of the market, and then use that for calculating where to place your stop loss. Next up, let's talk about the Kelly Criterion. The Kelly Criterion is a formula that defines the optimal amount of capital to be risked on a given trade based on the probability of that trade's success. So the underlying idea here is that you should risk more capital on trades with a higher probability of success. So a basic version of the formula looks at W, your percentage of winning trades, and R, the average gain of winning trades over the average average loss of losing trades. Trading platforms and software often have tools to automatically calculate the Kelly criterion, and so for example in MetaTrader you've got a MT4 indicator for the Kelly criterion. Next up, let's talk about the Martingale strategy. This strategy is one of the oldest systems in betting and gambling. It goes back to France in the 18th century. They used to use it on roulette, but it's still used in the financial markets also. The Martingale strategy is defined by taking a set profit on winning trades and doubling down your risk after a loss. So while this can be effective in range-bound markets and trending markets, it can quickly lead to ruin. You can imagine if a trade is going against you and the market just keeps trending in the same direction, and you continue to double down on that position, you're very quickly going to blow out your capital, you blow out your account. So this is actually the opposite of what I was trained to do by a risk manager. If I had doubling down on losers was really viewed to be one of the worst things that you could do. But there are traders who have been employing it in range-bound markets with some degree of effectiveness. Not a strategy I recommend. Whereas the anti-Martingale strategy, where you do the opposite, you double up your position size in the event of winning trades and take a set loss amount on losing trades. So here basically you're leaning into your winners and cutting your losses short with discipline, and that is more close to what I was trained to do as a proprietary trader. And I've seen more success certainly with this type of mindset, this type of strategy. So to conclude, I wanted to bring up the casino analogy. So the idea here is that you want to be like a casino owner. As a trader, you want to be like a casino owner rather than a gambler. So you know that occasionally you're going to have to make payouts, which equate to drawdowns. But you also know that over the long term, if you keep executing your business, which equates to your trading strategy, the odds of success are in your favor. So with a good trading strategy and solid risk management, you'll be like the casino owner rather than the gambler. And with that, I'd like to wrap it up. Thank you very much for joining, and look forward to seeing you at the next presentation.